Real estate investing can seem overwhelming, but it all comes down to one thing: knowing how to analyze a deal. The Foursquare Method is a simple four-box system: income, expenses, cash flow, and cash-on-cash return. By filling in these four boxes, you cut through the hype and focus on what matters, the numbers. You don't need a finance degree or fancy software, just a calculator and a willingness to learn. First, you tally up all the money the property could bring in. Next, subtract every cost of owning and operating it. What's left is your cash flow, the profit you pocket each month. Finally, compare that profit to your investment to see how hard your money is working. Let's break down each square step by step. The first square is income, all the money your property can generate. Start with the obvious monthly rent. Research similar rentals in the area using sites like Zillow or Rentometer. Don't just trust the seller's numbers, verify them yourself. Think beyond rent. Can you rent out a garage, charge for parking or pets? Every extra stream counts. For example, a Columbus, Ohio duplex rents each unit for $1,200 plus $100 for the garage, totaling $2,500 per month. Annually, that's $30,000 in gross potential income. Be realistic and conservative with your estimates. Overestimating income is a common rookie mistake. Write this number in your first square. This is your starting point for analysis. Next up, expenses. This is where many investors slip up. List every cost: property taxes, insurance, property management, even if you self-manage, repairs, vacancy, and capital expenditures. For our duplex, taxes are $300/month, insurance $100, management $240, repairs $192, vacancy $120, capex $192, total monthly expenses $1,144. Don't underestimate repairs or skip budgeting for vacancies. These are inevitable. Always include a reserve for big-ticket items like roofs or furnaces. Being thorough here separates pros from amateurs. Add up all expenses and write the total in your second square. This honest accounting protects you from nasty surprises. Expenses are the reality check for every deal. Now, let's see what's left over. Now calculate cash flow income minus expenses. For our example, $2,500 income minus $1,144 expenses equals $1,356 net operating income. Subtract your mortgage, say $950/month, and you're left with $406 monthly cash flow, or $4,872 per year. Next, cash-on-cash return. Annual cash flow divided by your total cash invested. If you put $45,000 down, including closing costs, your return is $4,872. $45,000 equals 10.8%. Compare this to other investments, savings accounts, stocks, and you'll see why real estate is attractive. Positive cash flow means the property pays you every month. This is the number that tells you if a deal is worth it. If the return isn't high enough, move on. The Foursquare Method gives you clarity and confidence. Always run these numbers before making an offer. This is how you make smart, informed decisions. Let's talk about what happens after the numbers. The Foursquare Method is your roadmap, but real estate is more than just math. Tenants, repairs, and surprises are part of the journey. Screen tenants carefully. Bad ones can wipe out your profits. Keep a cash reserve for unexpected repairs. Things will go wrong. Over time, your property can appreciate, rents can rise, and your equity grows as tenants pay down your mortgage. Sometimes a great deal on paper hits a snag, like a costly repair, but planning ahead keeps you in the game. Analyze dozens of deals before buying your first. Real estate isn't a get-rich-quick scheme. It's a get-rich-surely business. Patience, discipline, and running the numbers are your best tools. Use the Foursquare Method on every deal. Stick with it, learn from mistakes, and you'll build real wealth. Now go find your first deal.